The math of compounding is a psychological trap because, for the first few years, your discipline produces almost no visible momentum. Most investors quit when their balance fails to feel life-changing, unaware that they are merely in the invisible phase of the 7531 framework. To survive the early friction of wealth creation, you must stop treating your portfolio like a short-term experiment and start viewing the first 7 years as the mandatory price of entry for long-term exponential growth. Imagine trying to ignite a fire by rubbing 2 sticks together in a damp forest. For the first several minutes, your hands ache, your shoulders burn, and all you see is a faint, frustrating smudge of gray wood. There is no heat, no flicker, and certainly no flame. This is the brutal reality of the early stages of wealth accumulation. It feels genuinely awful. You dutifully carve out a portion of your paycheck every single month, but when you log into your portal to check the progress, the needle has barely moved. The numbers look stagnant, almost mocking your discipline. While the standard financial chorus tells you to simply stay the course or trust a vague process, they rarely identify the specific coordinates of the turning point. There is a definitive threshold where the math stops being invisible and starts becoming an undeniable force. To navigate this, I use a mental architecture I call the 7531 framework, which maps out exactly when this transition occurs and how to survive the wait. Consider the specific case of an investor named Veronica to see how this psychological friction manifests in the real world. At 28 years old, Veronica is doing everything the textbooks suggest. She earns a respectable living and has maintained the unwavering habit of tucking away $200 every month for 5 consecutive years. She has not blinked during market dips, she has remained a loyal participant in the global economy. Yet, during her most recent account review, she found a balance of approximately $14,000. Her immediate internal reaction was not one of pride, but of profound doubt. She looked at that figure and asked herself if all those years of restricted spending were actually worth it. After half a decade of perfect discipline, the total still feels like a minor clerical detail rather than a life-changing sum of capital. This is the exact cliff where most people abandon their strategy. They conclude that the miracle of compounding is a myth or that they lack the secret knowledge required to make it work. In reality, Veronica is not failing. She is simply navigating the heavy friction phase. Compounding is a deceptive creature because it does not follow the predictable, linear rhythm of basic addition. It is not a smooth, uphill stroll. Instead, it is much like trying to get a massive, rusted flywheel to spin. Initially, you have to throw your entire body weight against the iron, gasping for air while the wheel remains stubbornly motionless. But once that mass gains even a tiny bit of kinetic energy, the physics change. The momentum begins to carry the weight for you, and suddenly, the effort required to maintain speed drops significantly. The tragedy of most modern financial guidance is that it tells you to keep straining without ever explaining that the heavy lifting has a foreseeable expiration date. The foundational pillar of my framework is the number 7. While 7 years is not a rigid decree from the universe, it serves as the essential minimum duration for any serious investor to find their footing. This timeframe is critical because it allows the chaotic, short-term static of the stock market to fade into the background. If you look at your returns over a 12 or 24-month window, you are basically looking at a coin flip. You might be buoyed by a lucky streak or decimated by a sudden crash, and neither outcome would actually reflect your skill or the long-term viability of your plan. However, as you extend your view toward the 7-year mark, the historical data for broad equity markets shows that the probability of a successful, positive outcome rises dramatically. Committing to this 7-year block provides a massive tactical advantage, both for your wallet and your sanity. On a purely financial level, a 7-year window creates a safety net that allows your portfolio to breathe and recover from the inevitable periodic downturns that scare off shorter-term speculators. It gives the math enough runway to actually start producing meaningful interest on your interest. Psychologically, however, the shift is even more profound. When you decide upfront that you are on a 7-year tour of duty, you stop expecting your brokerage account to provide you with an emotional high every quarter. You stop viewing your monthly contributions as a pass-fail test of whether investing works and start seeing them as seeds that require a specific season of growth before they can be harvested. The person who insists on checking the soil every day for a sprout is usually the one who gets frustrated and digs up the seed just before it was about to break the surface. Success demands that you stop measuring your life in months and start calculating your progress in multi-year epochs. Persistence over a long enough timeline is only half the battle. If your financial engine is built on a brittle frame, it will shatter under pressure. This is why the second digit of our methodology is 5. We are not talking about holding 5 random corporate tickers or 5 different mutual funds that all secretly track the exact same basket of massive American conglomerates. We are talking about constructing 5 distinct shock absorbers that are fundamentally uncoupled from one another. To succeed, your capital must reside in segregated reservoirs that refuse to move in a synchronized dance. When one sector is taking a beating, another should be standing firm or moving in the opposite direction. The bedrock of this structure is broad market index exposure. Think of this as the primary anchor for your entire financial ship. By utilizing total market instruments or an S&P 500 index fund, you are essentially buying a slice of every productive enterprise driving the economy. Data shows that this specific exposure has historically served as the primary engine for wealth creation over the long haul. For the vast majority of people building toward freedom, this single category will likely represent the lion's share of their total holdings. It is the most reliable way to capture the collective ingenuity of the corporate world. To complement this, you need the steady pulse of dividend-oriented equity exposure. These are vehicles or specific businesses that balance long-term appreciation with the regular distribution of hard currency. It is critical to understand that dividends are neither alchemy nor a free lunch, yet their utility is immense. They act as a psychological stabilizer. When the market prices are moving sideways and the world feels stagnant, seeing a cash distribution hit your account reinforces your discipline. It proves the portfolio is a living, breathing entity that produces value even when the ticker tape is not cooperating. Risk and reward find their balance in the third category, which is comprised of smaller companies or high-growth equity. This is the high-octane fuel of your portfolio. You are intentionally inviting higher levels of turbulence here in exchange for the prospect of superior returns over the coming decades. Historically, these smaller players have outperformed their larger counterparts over vast stretches of time, though the ride is significantly more jarring. Because of this inherent instability, these assets must remain a calculated portion of the whole rather than the entire sum. Too many people suffer from a home country bias, which brings us to the necessity of international exposure. While the United States represents a massive portion of the global financial stage, it is not the only player in the theater. Diversifying globally grants you access to separate economic cycles, foreign currencies, and differing valuation levels. This acts as an insurance policy against the possibility that one specific national market might lose its lead or face a localized decade of decline. It ensures your future is not tethered to the fate of a single flag. Finally, every resilient system needs defensive assets. This category includes high-quality bonds, treasury bills, short-term fixed income, or even a strategic cash reserve. The exact mix here shifts based on your specific age, your ultimate objectives, and your personal stomach for volatility. While these assets rarely see the explosive growth characteristic of stocks, they serve a more vital purpose. They dampen the swings of the market and, crucially, act as a sedative for your nerves. This matters more than most analysts realize. True diversification is less about squeezing out every last basis point of profit and more about engineered behavior. A portfolio that is slightly less thrilling to watch but remains easy to hold during a market meltdown is infinitely more valuable than a mathematically perfect plan that you abandon in a moment of sheer terror. This leads us to the number 3, representing the 3 distinct psychological hurdles that can kill your progress before the math truly takes over. The first of these is the phase of doubt. This typically strikes within the first few years of your journey. You are putting in the work and making the sacrifices, but the total balance still feels like a rounding error. It is at this vulnerable stage that the noise of the outside world becomes loudest. The intermediate stage of wealth building is a psychological gauntlet where the initial novelty has evaporated, replaced by a grinding sense of frustration. This middle phase typically arrives once you have poured a significant amount of capital and several years of your life into the market, yet the resulting balance remains stubbornly unremarkable. You began this journey expecting a breakthrough, but what you see in your portal is merely a decent sum that fails to move the needle on your lifestyle. The danger here is immense. Many investors choose to jump ship at this exact moment, unaware that they are standing on the precipice where the chronological weight of their investment finally begins to outpace their individual contributions. Beyond frustration lies the final and most lethal emotional trap, the phase of absolute panic. This occurs when the market stops merely treading water and begins a violent descent. You watch your balance evaporate, perhaps even sinking below the total sum of every dollar you ever deposited. In this state, your biological survival instincts scream at you to liquidate and preserve what remains. While this urge feels like a rational act of self-preservation, it is actually the moment of maximum self-destruction. History confirms that while massive drawdowns are a standard feature of the financial landscape, they are almost universally followed by a resurgence. By selling during the trough, you do more than just lock in a temporary loss. You effectively amputate the future compounding cycles your capital was supposed to enjoy, causing permanent structural damage to your long-term net worth. How does one maintain their composure when the world appears to be melting down? The answer is to construct an emotional fortress long before the storm clouds gather. You must treat market volatility not as a malfunction or a broken promise, but as the mandatory toll for entry into the world of exponential growth. This requires a radical shift in how you monitor your progress. Stop obsessing over the daily fluctuations of your balance and start tracking the metrics you actually control: the consistency of your deposits, the growth of your contributions, and your unwavering adherence to the strategy. By automating your transfers and limiting your logins, you distance yourself from the noise of the present. When you internalize that crashes are not defects but the rhythm of the process itself, staying grounded becomes a matter of logic rather than willpower. This structural discipline leads us to the final, most underrated component of the 75-31 framework, the number 1. This represents a single, annual commitment to raise your contribution amount. While investors obsess over hunting for an extra percentage point of return, the act of feeding the engine more fuel is often far more impactful, particularly during the first 2 decades of the journey. If you keep your investment fixed forever, your wealth will grow, but if you incrementally boost that input every 12 months, the terminal value of your portfolio will be unrecognizable. To see the math in action, compare a baseline scenario of $300 invested monthly for 30 years at an 8% annual return. That path leads to a solid financial foundation. However, if you simply commit to a 5% annual increase in that monthly deposit, the final outcome expands dramatically. In the first year, this looks like adding a mere $15 a month to your $300 baseline, an amount that feels negligible. Yet, as your career advances, debts vanish, and your income rises, capturing a fraction of that surplus prevents lifestyle creep from devouring your future. Nudging your behavior upward in a way that mirrors your real-life financial expansion ensures that one simple, recurring annual adjustment will eventually outweigh the impact of even the most brilliant stock pick. The true test of an investor is not how they handle their gains, but how they survive the psychological drought that precedes them. Success in this arena requires a total commitment to a specific 4-part protocol. You must fix your eyes on a genuine multi-year horizon, engineer a portfolio across 5 separate risk categories to avoid catastrophic concentration, prepare for 3 specific emotional traps that derail most strategies, and implement a single annual increase to your deposits so the engine never stalls. This 75-31 framework is designed to provide the 4 essential nutrients compounding requires: duration, variety, mental fortitude, and escalating resources. None of these elements are particularly glamorous, yet their lack of flash is precisely why they yield results. Think back to the predicament facing Veronica. After 5 years of perfect discipline, she was drowning in disappointment. However, instead of surrendering her progress, she chose to pivot her philosophy. She made a pact to reach at least the 7-year mark, providing her capital the breathing room it actually needed. She dismantled her fragile holdings and rebuilt a more resilient, diversified architecture. By muting the noise of short-term volatility and incrementally raising her monthly contributions each year, she moved from being an observer of her wealth to the architect of it. It is vital to recognize that by the 7th year, the outcome for someone like Veronica is improved, but it is rarely jaw-dropping. This is a critical nuance of the journey. Even after nearly a decade, the mechanism often feels more dependable than it does exhilarating. But this is the threshold where the separation begins to accelerate. While year 7 provides a solid floor, year 10 begins to show the first true signs of lift. By year 15, the contrast is stark, and by the 20th year, the numbers transform into something genuinely significant. Eventually, you cross the invisible line where the annual gains generated by the market itself begin to outstrip the dollars you contribute from your own pocket. This is the fabled compounding summit, and the most common failure is the belief that one can reach it through a sprint rather than a marathon. The reality is that wealth is an accumulation of phases that serve different purposes. The early years are dedicated to laying a deep foundation. The middle years are for gathering the kinetic energy of momentum. The final years are where the dollar amounts finally become shocking. Most participants never witness this final stage because they abandon the ship during the unrewarding years when the work feels like a chore. This underscores why a boring, survivable system is infinitely superior to a thrilling, complex strategy that snaps under the first sign of economic stress. Long-term prosperity is not the product of constant tinkering, it is the result of keeping the machine running without interruption. To execute this practically, you must first define your timeline in blocks of 7 years, ignoring the quarterly emotional swings that cloud judgment. Second, verify that your diversification is authentic and not just a collection of different fund names that all share the same vulnerabilities. Third, treat the arrival of doubt, frustration, and panic as expected milestones rather than evidence of a failed plan. These are simply the moments where your character is tested. Fourth, remove yourself from the equation by automating your transfers so the plan proceeds regardless of your mood. Finally, commit to a small, recurring annual increase in your investment amount. True wealth does not originate from a magical shortcut or a lucky strike. It is the prize for those who remain in the game long enough for the final doubling cycles to occur. Compounding is never broken in the early days, it is simply operating in a quiet, invisible mode. Your primary responsibility is not to force it to be impressive today, but to protect the system until it reaches the point of visible acceleration. Please remember that I am not a financial advisor. This information is provided for educational purposes only, and any ultimate results will depend entirely on your own independent decisions and actions.